and welcome to Coffee Break Accounting with me, Becky Brooksbank. If you haven't already grabbed your cup of tea, coffee or drink of choice, press pause here, go and grab one and come back and join me for 10 to 15 minutes of jargon-free accounting support for your business. So welcome back to Series 3, Episode 4. We have been taking a journey through beyond the profit and loss account. So if you've been following me from the start, Series 1 was everything about the profit and loss account. And we have slowly been working our way through to understand the other documents that might be really important for your business and to see why you should know about them. So a couple of episodes ago, we had a look at the difference between cash accounting and traditional accounting. And with traditional accounting, I opened up a huge number of new concepts to you that you probably wouldn't necessarily have heard of before. The first one was the balance sheet. So if you remember, the balance sheet report was a document that allowed us to hold transactions and financial information for future gain in the business. Okay, so it's something that wasn't dealt with at the time. If you hadn't paid a supplier, you would put the invoice in the balance sheet ready to pay at a point in the future. Similarly, there are stock things to think about and all these different things that come about. So what I want to do now through the rest of Series 3 is take you through some of those really key elements, tell you what you need to know about them, about your business, and how they can really help you understand what is going on. So the first one, to ease you in gently, this is one of the easier concepts to get your head around, is fixed assets. So I'm going to jump straight in now to show you about it, okay? So first thing to consider, what actually is a fixed asset? Because to me that sounds a bit of accountancy jargon, and I told you I'd keep it as free as possible of jargon. So a fixed asset is a long-term asset that's used in the operations of your business. Okay, so let's think about some things, and if you look at the key characteristics hexagon, you'll see them all around there, to name but a few. So you've got things like furniture, buildings, computer equipment, land, vehicles, tools, machinery, otherwise known as plant and machinery. All these things are useful in your everyday business. You will use them within your business. But there are some key characteristics, okay? To be classed as a fixed asset, they have to have a useful life of more than 1 year. So thinking about PPE, for example, if you had a piece of PPE, protective equipment, for example, a safety hat or a mask, that wouldn't necessarily go under fixed assets, because the reality is with a safety hat, you might lose it. A mask could easily get broken. So the reality is likelihood the useful life will be less than 1 year. Okay. A fixed asset, they can be depreciated to reflect wear and tear. What does depreciation mean? And we'll touch on this a couple of times. Reduced in value. Okay, so let's think, going back to John Tapp, our case study plumber. I've just mentioned safety hats and visors. He might have a van. Okay, so a van is a vehicle which would tick a useful life of more than 1 year. So generally, John may have bought his van for 5 years. And as John uses the van, it gets older, there are new models brought in, likelihood is to have a dink, a scratch on the paintwork, all sorts of general wear and tear, so that when he wanted to sell the asset or it comes to the end of its useful life, he won't get as much money for it. Okay, so that's what depreciation does. It reflects the wear and tear of a fixed asset, key characteristic. They are used in business operations and provide a long-term financial gain. So sticking with John and his van, he needs that van to get to his jobs. It's as simple as that. The economic gain is that he uses it in order to go out to service his clients, to carry the tools and all the stock and all the bits he needs in order to do the job. That's the economic gain, which leads to financial gain because he gets paid for the work he needs to do. Okay. And then the last one is they're not easily convertible into cash, okay? Well, actually, you think, well, a van, well, I could sell it. Well, it might take a couple of months to sell it. Who knows? You might not get the right buyer for it, okay? You could get it straight away if you sell it to an auction house or anything else. But generally, it's not quite quickly convertible into cash. Okay. Thinking about another example could be of a bigger piece of plant and machinery, sticking with construction type things. Think of a JCB. So somebody would need a JCB on a construction site. Okay, those are big, expensive items that businesses invest in because they need them to do the job that they're going to do. That would have a useful life of more than 1 year, one would hope, when you're paying that much money. And it would get wear and tear and be depreciated over a period of time. Plus, if you wanted to sell it quick, JCB market, it's not everybody's thing. So it might take that bit longer to convert into cash. So hopefully that gives you a snapshot of what a fixed asset is, a few examples and some key characteristics. Okay. So what does this look like in the profit and loss and balance sheet? So we need to think about the treatment of fixed assets. So in the balance sheet, when John buys his van for £5,000, for example, he would capitalise the cost of the asset. So what capitalise means is it puts the full value of the asset into your balance sheet when you buy it, okay? So either he gets an invoice that he'll pay at some point in time, or he will just pay £5,000 for that asset, and that full cost would be capitalised. As each year passes that he's been using the asset, each financial year, he will depreciate the cost of that asset over the life. So if we stick with the example we were saying, if he's going to keep the van or aim to keep the van for 5 years, he will reduce the value of that van by £1,000 each year in depreciation. Okay, so he will charge against the cost of it £1,000. Now, what does he do with that depreciation? Well, he puts it against his profits. Okay, so originally, if we think back to the cash accounting that we were doing, if John was doing cash accounting, he would have paid £5,000 for the value of the van and hit his expenses straight away with the £5,000. Okay, that would have been as simple as his transaction would have been at that point in time. Now, if you're under traditional accounting, you haven't recognised that cost at all. What you're saying is you're going to recognise the cost over 5 years. So your profits will not be reduced all in one go. They will be reduced by £1,000 over 5 years. And you repeat that until the asset is either fully written down to zero, i.e. 5,000 less 5 1,000s, or you sell it, because there's no, you can sell things. Just because you put it in the balance sheet doesn't mean you have to keep hold of it forever. Okay, so if you sell it, what you then do is you figure out how much it's worth in your books at that point in time. So say John sold it after 2 years, he would have written it down to £3,000, being 5,000 less 3,000 in depreciation. If he then got somebody to buy it for £3,500, he's got a profit of £500 because they've paid more than the value of the asset at that point in time. Okay, so that's a slightly more technical one to get your head around, but hopefully you can see how that would work. Now, one thing to draw you to at this point in time is how on earth do companies keep track of all these things? Well, there's 2 things to think about. One is you put some rules in place, okay? So you don't have to recognise everything. And what a lot of my clients do is they'll have a de minimis level, okay? So they might say that they won't recognise as a fixed asset anything under £500. Anything under £500 would go straight through their profit and loss as equipment. Okay, so if we think of John the plumber, our resident case study guy, if he buys a big DeWalt drill, for example, that might cost him a couple of £100. It would likelihood have a useful life over a year, because you hope he's going to use it for a couple of years before it broke or whatever it is. It would be subject to wear and tear, and it's got economic gain because he's going to use it to do the job. But if he did that for every single bit of equipment that he bought, he would have a list as long as your arm, and keeping on top of that's really tricky. So John has decided that if he's doing traditional accounting, he'll have a de minimis level of £500 for all his capitalised items. Anything else under that will just go straight to the profit and loss account to make it easier. Okay, so it's okay to do that. Generally, when you're talking bigger assets, bigger pieces of plant and machinery, then you will obviously be able to keep track. Now, you can keep track of anything. So I mentioned furniture earlier. I'm sat in my office at the moment, and we do have some desks and filing cabinets and everything in here. Now, I use the de minimis level as well for my own personal book, my business books. So these aren't included, but you could, if you wanted to, capitalise them through your books. Okay. Now, in order to keep track of them, and I put a note at the bottom, you need to have a fixed asset register. Okay, because you need to know what everything is, what adds up to that balance that you've got in your books, and even where to find the asset. Okay, so you can create a fixed asset register that is basically a list of the date you purchased something, what it was. If you're super organised, you can put a serial number in there, or a warranty number, or anything else, and then you'll have a cost against it. Okay, so that's the original cost that you recognise in your books. A fixed asset register then allows you to track depreciation. So every time you depreciate the asset, you will just add in the depreciation. And if you do cost less depreciation in your Excel summary, you will come back to the value that that asset is worth at whatever time you're looking at it. Okay. So a fixed asset register becomes a really key part, particularly advisable to start it when you first start recognising assets, because backdating it can be a real pain in the backside. Okay, now if you're using a piece of software, for example Xero, they have a really great system in place that if you set your fixed assets up correctly, every time you expense something to the balance sheet under a fixed asset, it will ask you if you want to register that asset, and it will capture all the details and produce a fixed asset register for you. Now, obviously, if you don't use Xero, and one of the other leading competitors doesn't do that, then simplest thing to do is create an Excel spreadsheet to record those assets. Okay, remember, key, do it as you start, as you add an asset, because it will make life so much easier for you. Okay, so that is fixed assets for you. And on the vein of a fixed asset register, your takeaway task for today is to go and get your fixed asset register started now if you haven't got one in place. If you do a Google search for fixed asset register, then you will find examples that you can follow, but it really needs to be quite simple, a number of columns like I've just said, with a total on it for the current value of your asset. Okay, so don't leave it until there are too many items and you've lost track of them all. Go on and get sorted on your fixed asset register now. So that was fixed assets. Next week we will have a look at cash and bank, I think, and give you some top tips on how to look at cash and bank, keep on top of all that type of thing in your business. Okay, thanks for watching today, everybody. Go away, have a go at those fixed asset registers, and I will see you next week for episode 5 of Coffee Break Accounting. Take care.